What is up, traders? What's up, tycoons? Super excited for today's video. Going to give you guys an update real quick on the market. We're going to take a look at TLT in the video as well. But before we do, and before we look at the bonds, there's some very crucial and important data that I've been tracking and showing you guys in some of my recent videos that we need to cover. Okay, so make sure to smash the like button if you're new to the channel, subscribe as well, and we'll go ahead and jump straight into it. So on this chart specifically, what we're looking at, right, is we're looking at the National Financial Conditions Index, the adjusted National Financial Conditions Index, and the S&P 500. Okay, so the whole mission of Jerome Powell is really to tighten these financial conditions. Okay, and by tightening financial conditions, ultimately as a result, that's going to bring the market down. Okay, so this is November of last year, and we see we start to see this rise in the national financial conditions. Okay, they're tightening, they're getting tighter, they're coming up. And really, this is when we see the stock market ultimately start to crash and start falling. Okay, the the S&P 500 is going to be this, teal line right here, and the financial conditions are these other two. In my last video, I pointed out that we were basically baselining right here at this level. Now, we actually did end up holding this level and rising a little bit. Okay, previously we were actually a little bit below it, or really just baselining right here with it. But as a result of Powell's hawkish speech, as well as just stocks crashing in general, right, we see that we had a nice dip in there. This started to curl back up a little bit. Okay, so it's really important to kind of understand what we're looking at here. Each time that you see this thing is rising, right, and you see the sharp rises in this, we're seeing a decline in stocks. All right, and so that's been the pattern. And this is really just kind of what the Fed ultimately wants to see. Now, they have been seeing a lot of good things, right? We are seeing that inflation is just more sticky than it wants to be, than what people want it to be, and maybe the Fed wants it to be. But it is actually trending down finally. Okay, we did get 2 consecutive reports of the CPI going lower. So that is good to note and good news, but we need to really pay attention to things like these as well. Okay, so if this starts to tick back up and keep continuing to rise, I would expect the S&P 500 to continue to have a decline, right? And we're using the S&P 500 as kind of just like a baseline of the stock market. Now, the next one that I want to really point out to you guys is going to be the 10-year, 2-year Treasury yield, as well as the 10-year, 3-month Treasury yield. All right. Every single time, and we'll take a look on the next chart, but currently it is inverted. Okay. If we look at the present day data right here, both of these are negative. It is inverted. This has preceded a recession historically since like the 1950s. Okay. Maybe 1950, 1955. I don't remember the exact date, but this is your number one predictor for a recession. So 2023, we're pretty much almost guaranteed to have a recession. So you need to prepare yourself mentally for that. The pain is not really over. And most likely we're going to see more pain in the stock market in 2023. That doesn't mean we can't have rallies, and that doesn't mean we can't trade sideways even for a little bit and really just consolidate. But it definitely means we're not going to be making new all-time highs, especially in a lot of these small caps and innovation stocks, as well as tech and growth. We're going to show some things later on in the chart. We're going to look at, growth versus value, utilities and things like that, and how those are still outperforming and showing more strength than some of these other plays, right? Some of these other riskier asset plays that are really much more affected by the federal fund rate. These rate hikes, they take 6 months to a year to hit the market. All right, we started really rate hiking aggressively in the summer. It's been about 6 months now, and we're starting to see some of that pain. The rest of that pain will show up in the economy next year. All right, that's really when we're going to see a bunch of it. So right here, we're looking at the 10-year, 2-year again, as well as the 10-year, 3-month, and the S&P 500. And I just want to show you guys, okay, the 10-year, 3-year, and the 10-year, 2-year are in purple and blue. And once you see a spike, or when you see these drop down and get inverted, right? So this is the 0 line right here. Okay, this is your 0% line. When you see these come down, that's when you see in the future, right? It doesn't happen immediately. There's not a crash, right? We go up a little bit and then we come back down, right? Now, this, of course, was the COVID. So I'll show you guys a better example, but look over here, right? Over here, we continue to go up higher, consolidate a little bit, and then ultimately we get a really big pain, right? And this is 08. Right here, we can see again, that we come up, all right, and we're seeing, the yield curves invert, and then what happens? All right. In the future, we have a very sharp decline in the S&P 500. Now, look at where we're baselining at right now. We're baselining right here around the 0203 timeline on the 10-year 3-month treasury yield, which is a lot more better of a predictor of a recession than the actual 10-year 2-year. So I really like to use this one, but these are the two main ones that people look at. And we'll just show some more examples, right? So they're inverted over here, and it's a little bit hard to tell on this chart, but we actually get a very steep decline again. Okay, right here we get inverted, and then in the future we have a crash. And it really just continues, right? Over here we're inverted, and there's a little bit of a crash right here. It's just harder to tell because on this chart, because the S&P 500, the stock market has grown so much, and really just prices have gone astronomical. But the main thing you want to look at is look at what happened last time when we hit these levels. We saw a very sharp decline in the S&P 500. Over here we got close to the same levels that we were at right now. Okay, and we saw another very sharp decline. So I'm expecting to see something similar in 2023 or 2023. Now, what we're looking at right here is something that's very interesting that I think a lot of people should actually track. This is the percent of companies trading above their 50 simple moving average. This is a really good way to gauge momentum, and really good way to gauge sentiment, right? Current sentiment and really how the market is feeling. Okay, so that's going to be in your blue line, the percent of companies trading above their 50 SMA within the S&P 500. And then this purple line here is going to be the actual S&P 500 itself. So what we see and what I pointed out in my last video is that we were peaking, right? We were peaking at previous levels that we previously hit, okay, and then ended up falling. And, I said, hey, we could, basically that bullish momentum is very bullish. We could continue a little bit higher of a push, right? And we did. We came down, we pushed up higher, made a new high on this. So this is 0.92. So you got to think about 90% of stocks in the S&P 500 were trading above their 50-day simple moving average. That's a really good gauge of momentum. And it showed that, hey, at the time, things were really bullish and we kept getting those pushes. We kept getting a push higher. And a lot of people were surprised on that. And some people weren't. They were thinking it was going to be in anticipation of a, negative of a declining CPI report, which we did get. And we did get a very sharp pop on that, but we'll go over why, I wasn't so bullish after we got that massive print, right? I did have a really good trade on that. And, I cashed that out right as soon as the market opened. I sold out of that position on the CPI day. And we've been holding some puts in the Discord, and it's that's been working pretty well for us. But the next thing we're going to look at, okay, is the percentage of companies in the S&P 500 trading above their 200-day simple moving average. So these are some of the two most common, and really just there's hedge funds, there's institutions out there that simply buy in just based off of these analysis, right? If a stock is trading above its 200 moving average, there's a number of institutions out there that are literally going to just buy in because the stock is trading above its 200 simple moving average. And that's historically been, a semi-successful strategy, right? And, it may not be the best strategy, but it's a very simple one. So when you look at the 50 and you look at the 200-day moving average, it really helps gauge. All right. And we can see, we kind of had this triple top up here. All right. And, a lot of them, look at how high this got. This was the highest we've been since the very beginning of, or since the very end of the year last year. Right. And we know that last year was pretty brutal. Okay. The S&P 500 actually continued to make new highs as it went into January. And then, that's when we had the collapse, right? So this is January last year. We can see we were at very elevated levels, looking at the percentage of companies trading above their 200 simple moving average. Right. And so we're seeing a very similar thing, right? We're seeing that, okay, man, the market is super, super bullish. And now this thing has completely puked, right? So this is just basically another way to gauge, as I was saying, momentum in the market. And, you want to check upon these things, right? If you're seeing the S&P 500 rallying and you're not seeing a large amount of stocks above their 200-day simple moving average or a lot of stocks above their 50-day simple moving average, then that kind of lets you know that, hey, well, maybe this is a fake out and maybe the index is climbing, but individual equities aren't really climbing as much. And it could be an indicator that, the S&P 500 is due for a pullback. Right. The next thing we're going to look at here is actually SPXM, all right, which is the S&P 500 momentum index. Now I'm sharing with you this with you guys because I'm not here to provide financial advice, but I'm here to inform and try to help educate on some possible other investments that you could look at, or things to help, again, gauge momentum, gauge sentiment, right? And so what we're looking at here is, in blue, we have the S&P 500 momentum index, and in purple, we have the S&P 500. We can take a look from its highs. The S&P 500 is down 17.36%. From its highs right here, we're only down 8% on the S&P 500 momentum index, right? So you can actually, they balance this and they rebalance this twice a year. They do it in March and they do it in September. So, we're coming on the end of the year, and when March comes, this will be a really good way for you to possibly evaluate some new stocks that will be that you could look at that are having good momentum, even in a bear market, right? We're seeing that this index is outperforming the actual S&P 500. Right here, also, we have the cash cows ETF. And what I've done is I've just basically paired this up with the major stock indexes. Okay, so the cash cows ETF is going to be this one here in blue. I have the S&P 500 in orange. We have IWM in this teal blue right here, and then we have the NASDAQ in yellow. And if you take a look, this is only down 8%. The cash cows ETF, what that is this is an ETF that focuses on the Russell 1000, and what it does is it looks for stocks with high free cash flow yield. All right, that's something that's pretty important, especially in a recessionary environment. And these bear markets is, these are the companies that the stock market is going to respect. So if you see, cows is only down 8%. Meanwhile, the S&P 500 and the NASDAQ are down anywhere from 14.5 to 23% year to date. Okay. Now what we're looking at here is actually, this is goes back to the momentum index. And this is how you would use it, right? So what it does is it gives you the top 10 constituents by index weight. So you can see within the S&P 500 momentum index, you can see what companies are the top holdings, right? And these were all rebalanced back in September. So the way you can use this, and it also shows you the indexes and the index weight. So we can see healthcare and energy are leading the way. This is a very clear sign that we're in a bear market, right? Anytime you see XLE or the energy sector leading the way, and you see healthcare, these are very defensive plays. You typically in a bull market, you're going to see technology. You're going to see things like that much outperforming healthcare and energy, right? And so the momentum index realizes, where the momentum is in the market, and 60% of the momentum index is shuffled into healthcare and energy. So again, in March, you'll be able to take a look at this, and they'll rebalance it. It'll be public, and you can go in there and say, okay, well, where did they increase their weight in energy? Did they increase their weight in healthcare? Did they increase their weight in consumer staples? What are the top 10 stocks in the index? And you can use that to, try to, as a basis to further make some more informed decisions on what stocks you want to get into, what stocks you want to play as you continue into the year for 2023. Okay, so now we'll go ahead and we'll get into the bond market, and we'll take a look at those, take a look at everything over there. We're going to start off with TLT. All right, and now we've been tracking this pattern. It's a 5-wave pattern down. It's the main pattern that we've been tracking. We have 1, 2, 3, 4, 5. Your 1, your 3, and your 5 are going to be what's known as 5-wave impulsive waves, right? So within that 1 wave and that 5 wave and that 3 wave, you're going to have 1, 2, 3, 4, 5, right? And that's what I'm going to show you guys has been following all year. We have our 1, 2, 3, 4, 5, and then your wave 2 and your wave 4. Those are correction waves, right? Those are corrective waves. And with the Elliott wave, you have an ABC corrective wave, right? So you have a wave 1 up, 2 down, 3 up, right? You have your A, B, C, and it's been playing out very well. Now, these 3 numbers right here are the Fibonacci retracement levels, the 61.8, the 50%, and the 38.2. The reason we use those is that these are the 3 most common and most well-respected, retracement levels there are. And if you break through these levels, then you have a reversal of the trend. So in this case, we are in a downtrend, right? So we're measuring our swing high up here down to the swing low. If we were to break through these levels, we would have a reversal, right? But otherwise, we're just getting a standard healthy retracement. Okay, from our wave 1 to our wave 2 should retrace up to one of these 3 levels for it to be valid. Okay, now once we do that, you see here we get a very clean rejection off the 50% retracement level, and we head down, right? Now, what are some of the other signals besides these major retracement levels that you can use for a possible big drop in the market, right? I really like to use the MACD. And we can see here that, okay, hey, we get a rejection at our 50%, but let's say we want a little bit more confirmation that we're not going to come down. You see, we try to hold support here for a little bit before breaking. This right here is going to be your indicator, okay? If we zoom in a little bit more on it, your sell signal is going to be when this blue line crosses below the orange line, right? Every time that has happened on TLT, we've seen a very sharp drop afterwards, right? So we have our sell signal right here, and then we get a very sharp drop. Over here, we have our sell signal, right? And then we get a very sharp drop. Over here, we have a sell signal and we get a very sharp drop. So I've been waiting for this confirmation on our current levels on TLT, right? So we went over the 1 and 2. We had an ABC up. Our wave 3, we had a 1, 2, 3, 4, 5 down, right? And we got our correction wave, right? So we're currently in our wave 4 of this 5-wave pattern down. We have A, B, C, okay? That's our corrective wave, and we're really just consolidating right here before moving higher. Now, if we zoom in, I really want to show how, well respected these levels are and, why these strategies work. No strategy is going to work 100% of the time, but once you can start to combine some of the things together, which is why we look at the MACD, why we look at the relative strength index, and other things as well, using the fib retracement levels besides Elliott wave, we can see we literally got a perfect rejection right here at our 61.8 retracement level, which was 109.72. So, we've really consolidated right here. You could say that this is a little bit of a bull flag. So what we're waiting on is confirmation on TLT for a sell signal on the MACD. Once we get that sell signal on the MACD, that's going to be our confirmation that most likely we're going to come down, fill this gap right here, right around 102.94, also our 38.2 retracement level. And then ultimately, if we break through there, we could come down all the way down to here on TLT, which would be about 95. Okay, now that would be extremely bearish, and you could expect to see a lot of pain in the stock market. Now, these blue boxes here are gaps. They're what's known as gaps on the daily chart. These fill about 90% of the time historically. The main question is, when are they going to fill? So I was really watching out when we were coming up and testing these levels to see, were we actually going to be able to come up and fill these levels? That was something that I was really looking at and trying to see as a possibility. We haven't yet. There's still a possibility we could. We're currently holding the 50% retracement level at 106.33 as support. So really, the main 3 levels I'm watching is 106.33. We want to see it drop below there if you're bearish on the market and you're trying to short it. That's the level that you need to break. And then we have 102.94. Is going to be our next major support level. And below there, most likely we, again, are going to come down and fill these gaps. And really, start to see some pain in the stock market. Our confirmation is going to be on TLT once we get that MACD crossover to the downside. Okay, now the S&P 500 looks a little bit more bearish. We'll take a look at that real quick, and I'll go ahead and break that down for you. So the S&P 500, we already got our MACD crossover, which is why I was saying, this thing looks much more bearish, right? And that's not really a surprise after we got that crossover, and we've just seen lots and lots of pain, right? We have our CPI print right here. We come up, and then it's just been a complete sell-off since then. Now, in the last video, I highlighted on SPY on the S&P 500 that once we, because we got this MACD sell signal, most likely we're going to come down and fill this gap to about 381. We'll go ahead and take this off the chart because we have filled this gap. Now there's 3 small gaps to the upside, and we are at our major support levels, right? So we're using the fib retracement levels again. And what we're doing is we're looking to see where it could possibly bounce at, right? So we have our swing low right here connected up to our swing high, and we're seeing that we have the sharp move to the upside. We're coming down. We're currently holding our 50% retracement at 379.15. Okay, there's a strong possibility that if we were to bounce at these levels, okay, we could end up actually getting a 5-wave pattern, right? So remember, the 5 waves are impulsive, and that's what we've been tracking as a big 5-wave move down. And your wave 1 should be 5 smaller waves. Your wave 3 should be 5 smaller waves. And then your wave 5 should be 5 smaller waves, right? With the 2 being an ABC and your wave 4 being an ABC. So basically what I'm getting at here, okay, is that we're doing 2 things right now when it comes to the stock market. We're either in an A, B, C, D, E up, right? That would take us to fill the gap up on the S&P 500. Or, it looks like we've already started our wave one to the downside, right? So we had got a clean rejection up here, right? It looks like our C wave topped out on the corrective wave, and it looks like our wave four topped out. And if that's true, right, then we're coming down and we're already at our major retracement levels. So any one of these levels is good for a bounce. But ultimately, the bounce would just be to end up going lower, right? So once we put a bottom in, we can figure out our retracement levels to the upside that we need to, hold as resistance. Okay, but it looks like I mean, if we just look at it, guys, things have been working out pretty well with this strategy. Okay. Here's when it started, and we'll go over it again, right? We have 1, 2, 3, 4, 5 down. And it just keeps happening over and over. And then we get an ABC correction, ABC. Then we come here, we get 1, 2, 3, 4, 5. And then we get ABC correction. And it looks like we're starting our 1, 2, 3, 4, 5. Now, the reason that I'm leaning more to the bearish side is because of all of the data that I was just showing you guys earlier. Okay, we looked at financial conditions, we looked at how those affect the stock market. When those conditions tighten, we're going to see things drop. All right, and we've been seeing the S&P 500 drop. We looked at the 10-year, 2-year Treasury yield, the 10-year, 3-month, and those are all predicting a recession in the next 3 to 9 months. So if that is to be true, it would make a lot of sense for the S&P to start pricing that stuff in and see this 5-wave impulsive move down. So the main levels we really have to watch is 386, 379, and 371. Okay. We'll go ahead and take a look at some more bonds real quick. TLT has been the leading indicator, but HYG is really nice to look at as well. This is the high yield corporate bond ETF. And as you see here, we had a little bit of this bullish falling wedge right here, okay, that we've really just been kind of trading in. And, we did get a breakout, but it was a false breakout, right? To me, it looked like a look above and fail, right? So we've been consolidating in this bullish pattern, and you were looking to see if we were going to break out to the upside. Well, we did break out, but it looks like we got to look above and fail, and we're closing back below this major trend line. In this process, we've created a rising wedge, which again is a bearish pattern. And we also have our MACD sell signal on HYG, which is the high yield corporate bonds ETF. So really, I'm going to be looking to see if we can break these trend lines right here. Okay, if we can break this trend line to the downside, all right, this trend line right here, then that's going to be, that's going to be another thing that's just really going to help, bring the stock market down, and you're going to see the stock market fall more. Okay, this rising wedge right here, if we break this trend line again, and what we're going to do is we're going to look at our 3 major retracement levels, okay, to see these are our major support levels. We're taking the swing low up to the swing high, and if it pulls back and finds support at any one of these 3 levels, and we, push higher, there's a strong possibility we could end up getting new highs. So you don't want to be too biased to one side. You want to keep open possibilities, to both sides, and really just let the levels play out. Okay, TLT again has been the leading indicator. We haven't got the MACD sell signal yet. HYG, we did get the MACD sell signal. We have this nice bearish pattern forming. If we break through this bearish pattern, then your shorts are going to be paying in the market. But there's a possibility that there's always going to be a possibility that we could continue to rally or get some type of rally in the market. Now, some other ways that we can really measure all of this, and we'll take a look at TNX real quick. Actually, TNX has been pretty bearish. If you take a look here, we have this head and shoulders playing out. There's 2 gaps down that it looks like we're going to be heading and filling. We are starting to consolidate a little bit here. Our MACD is starting to curl up a little bit. So, if this thing starts to curl up and start trading above the orange line right here, that could be a bullish signal. And you could see, some of the stock market try to rally off of that. But again, we have our head and shoulders pattern right here. We have our left shoulder, we have our head, we have our right shoulder over here. And, we have a gap down to 3.151 and then a gap down to 2.896. If we get the first gap filled to 3.151, that would complete our head and shoulders pattern and really take it back to the bottom to where it started. Okay, you could say that this pattern is already complete and that it started right over here, right in this range and through here. That's perfectly fine. I can see that. This does look to me to be a little bit like a bull flag, or not a bull flag. I'm sorry, a bear flag, right? So here's your flagpole, right? And then here's your flag itself. And things look pretty bearish. So if we break this trend line here, most likely it's going to come down and fill this gap. Let's take a look at the VIX real quick. All right, the VIX, man, this part has been really, really important. And I hope everyone caught it in my last video. I've been trying to emphasize this. The VIX is one of the main things that I watch pretty much every single day, and it's very one directional, right? So we'll drag these down a little bit. And what we're going to be looking at here is that, yes, it's one directional, but every single time the VIX, all right, so right here, we're bullish, right? It's bullish for about a month or two. Then we get a breakout. And every time we get a breakout, it has a sharp pullback and then ultimately to continue heading up higher, right? We see the same thing over here. We're trading downwards, right? We're trading downwards and, the stock market is bullish right now. The VIX is almost like an inverse of the S&P 500. They don't directly correlate every single time 100%, but when you see the VIX going up, you tend to see, the stock market with some pain, right? So we see a breakout here, and then we see another sharp pullback, and then it continues up higher, right? And I was telling everybody to watch out for this as soon as it pulled up like this. We got our breakout. Here's another example, right? Where it's one directional. We're trading in this one direction for all of this time. The stock market's rallying. We break out, we pull back, and then we continue up higher. And then VIX is one directional to the upside, right? This is our most recent breakout right here. And we can see that we actually did just get that, right? It was one directional. Things were going down. We break out. We had a very sharp pullback. Okay. This is a steep decline. And we're starting to possibly get our rally to the upside. So, I have been looking at VIX call options a lot in the Discord, right? If you guys ever want to join the Discord and get live market updates from me and all of the other admin members, and really just the plethora of data sources and intel tabs that we have inside of there, you can always join the Discord. The link is in the description. Use code ZACHLY for a discount. And you can just see what it's all about in there, right? We have lots of people making lots of money, right? We have people making 10K a day. We have people making $100 a day. And there's even some people with some large trading accounts making six figures even in a single day, right? So we're taking a look at VIX here. We'll take a look at skew next, which skew is really nice. What this does is this is going to measure the out of the money protection, right? So VIX is monitoring call options and put options based on the S&P 500 index. What skew is doing is it's going to do the same thing, but it's measuring out of the money. Okay, what out of the money means is if the S&P 500 is at 380, then someone is going and buying 370 puts, those are out of the money, right? So those are a little bit more aggressive. So whenever you see large spikes in the skew index, okay, then that's an indicator that you could be seeing a sharp decline in the market, right? And we've seen that multiple times. Okay. This was a couple Fridays ago, maybe last Friday or 2 Fridays ago. And, that resulting Monday, we had a very, very steep decline, right? And so we're seeing, skew is really on this uptrend right now. It hasn't created another higher high and it hasn't broken out from this pattern right here. This is, again, a bullish pattern, a falling wedge. And truly, I think if we get a breakout in here, that's when we're going to see some max pain in the market and potentially be near a short-term bottom, if not a long-term bottom. All right. So that's something that I'm really looking for is to see, can this thing make a new high? Can this thing break out? And if so, how much pain is it going to bring into the stock market? Now, another way that we can, something that I really like to look at, okay, is SPY G versus SPY V. Okay, this is the growth versus value. This is the growth sector versus the value sector. And what we're seeing is that, for the whole year, we've been trading in this bearish channel. Okay, we've been trading here in this bearish channel. All right, it's no secret. And what this does is this, if you see the growth sector outperforming the value sector, then typically you're in a bull market, right? And typically you're in a economy that has good financial and basically like good financial conditions for it. Okay, what I mean by that is it has low interest rates for these growth companies because a lot of times these growth companies need to take out loans. Okay, they need to take out loans to fund this future growth versus the value companies. They're already there and they're providing value. So we see, it's been on this decline. Okay, we do have a little bit of a falling wedge on this one as well. So if we see a breakout on this, then that could be a good gauge to see, okay, hey, well, the market is going bullish here, right? And we're actually seeing growth outperform value. And that could be, just another sign, another tool to use as a signal for when this bear market could possibly be over, right? So I'm going to be watching this one pretty closely. We've been seeing, again, it's no really surprise to see growth underperforming. When you see this go down, growth is underperforming value. Another one that I really like to look at a lot is XLU/XBI. What this is the utility sector, XLU versus XBI. XBI is actually the biotech sector, right? And so what this does is this basically measures risk on versus risk off. Okay, XLU is pretty much the most risk off sector. It's utilities, and then you have XBI, which is pretty much one of the most risk on sectors, because biotech, as I said earlier, I was mentioning, interest rates and taking out loans. Biotech companies are extremely aggressive when it comes to that. Okay, what you're doing is you're buying a non-profitable company when you're investing in these in hopes that the loans that they take out will finance and fund the research to bring some type of drug or some type of product in the biotech space that will end up generating the company massive profits, right? And so once you see that, and you can see here that, so when this is going up, this means that the market is risk off. Okay. It means that utilities are outperforming biotech. And generally, as I said, this is a really good way to measure risk on versus risk off. So we're seeing, the market is not risk on, right? It's actually risk off. We see this decline, but over the past few months, we've seen this thing start to tick back up. And we're seeing that the market is going back to risk off, and it's not risk on right now. We actually had a breakout and a retest, right? We broke out, we retested this triangle pattern right here, and we're continuing to push higher. Now we're measuring the retracement levels on this one as well. We're taking our most recent low, or not our most recent low, but we're taking our low from over here, measuring it up to the high, and boom, we're having this move right here. And we're holding our retracement levels pretty well, consolidating mostly, right? We're mostly consolidating in them. So we haven't seen a major increase in the market going risk off versus risk on, as it was previously. But if we start to see this thing continue to go up higher, then you can expect the market to be, performing, underperforming, basically, right? And you can expect to see growth, innovation, biotech, and plays like those that are a little bit more risk on continue to underperform the market. So I think I'll go ahead and end the video there. We covered a lot in the video. If you made it this far, please smash the like button, subscribe to the channel. I do viewer requests every week too. So I know we went over a lot of tickers in this one, but if you want to see your specific ticker in the next video, all you have to do is comment down below. I'll be happy to make a video on it as soon as I can. And with that being said, I'm out.